Equities are testing fresh record highs just as inflation, higher yields, and a massive AI spending wave start to clash. This is vTalkInsight, Equity Pulse Daily for June 3rd, 2026. We will look at how a powerful earnings boom, an extended AI infrastructure cycle, and stubborn macro risks are reshaping the risk and reward picture for global stocks, from index-level dynamics down to the companies driving today's move. The S&P 500 has just notched another record close and is on track for a rare 9-day winning streak. Breadth has improved, with typically defensive utilities, alongside materials and energy, contributing meaningfully to gains, while semiconductor names and even small caps are outperforming the broad large cap benchmark. Under the surface, the macro backdrop remains unusually strong, with first quarter S&P 500 earnings growth around 29% and forward estimates for 2026 and 2027 moving higher. That profit momentum has allowed equities to climb without relying on richer valuation multiples, even as the Federal Reserve is widely expected to stay on hold and only consider cuts if unemployment rises meaningfully. The tension is that inflation progress has stalled, particularly in non-housing services, and recent readings around 3.8% keep talk of further tightening alive. Repeated supply shocks since the early 2020s, including in energy, suggest bond yields may remain structurally higher, and several commentators flag that a move in the 10-year Treasury toward or above 5% could force a rethink of equity valuations and trigger volatility. Abroad, Eurozone inflation has pushed above 3%, reinforcing expectations of European central bank hikes into a soft growth backdrop, while the Bank of Japan is viewed as behind the curve with 1 or 2 increases likely. That divergence supports the US dollar and helps keep capital anchored in US assets, even as bond markets look more attractive to some allocators. With the VIX still in the mid-teens despite these cross-currents, labor data, inflation prints, and moves in long-dated yields remain the key macro signals for equity risk over the summer. Recent gains in the S&P 500 are being driven primarily by earnings, not by investors paying ever higher multiples. Forward price-to-earnings ratios have edged lower since the start of the year because profits have risen faster than prices, and analysts are upgrading forecasts into 2026 and 2027, which supports the case that current index levels are at least partly grounded in corporate performance. At the same time, that 29% surge in forward earnings growth is being compared to post-crisis and post-pandemic rebounds, raising questions about whether the current expansion is overheating. Commentators warn that such rapid growth can ultimately challenge market multiples, especially when leadership is concentrated in a narrow group of AI-driven technology and communication services names. Concentration risk is visible across regions, with the MSCI Emerging Markets Index heavily reliant on AI-linked stocks such as Samsung, SK Hynix, TSMC, and MediaTek, while many other constituents lag year to date. In the U.S., momentum strategies dominate performance, with both retail and hedge funds increasingly forced to buy what has already rallied, at a time when hedge fund leverage and cross-strategy correlations are elevated, making the system more vulnerable to an abrupt regime change. There are, however, signs of healthier breadth beneath the mega-cap AI story. Small-cap equities are quietly outperforming what sentiment would suggest, and sectors like utilities, materials, energy, and select consumer names such as Dollar General, Victoria's Secret, and Ulta Beauty are delivering strong results. The key question is whether this nascent broadening can persist if the core AI complex ever stumbles. The AI investment boom now looks like a multi-year infrastructure supercycle rather than a short-lived theme. Around $600 billion has already been raised in the past 2 years through debt and equity to fund AI infrastructure, and AI-related capital expenditure is projected to jump from roughly $700 billion to $1.2 trillion next year. With aggressive build-out expected through at least 2027 and estimates that this could add more than 2% to GDP and make 3 to 4% real growth in 2026 plausible. Alphabet sits at the center of this shift, planning an $80 billion equity raise, its first of that scale in nearly 2 decades, including a sizable investment from Berkshire Hathaway and a convertible component. The proceeds are earmarked for proprietary TPUs and vertically integrated data centers, effectively turning its AI capital spending into a major capital markets event. Markets have absorbed the deal with only a modest share price drop, underscoring both abundant liquidity and the sheer capital intensity of staying competitive in AI. Nvidia's latest earnings delivered an unprecedented positive surprise, with management signaling that demand for AI hardware should remain elevated at scale for at least 2 years. That outlook is spilling over to names like Marvell Technology, which surged after Nvidia's chief executive suggested it could one day reach $1 trillion valuation, and to Broadcom, which is seeing upgraded expectations for custom AI chip revenue in the second half of 2024, helped by its tight integration with Google's TPU roadmap. In memory, AI-driven demand is creating sustained tightness in supply, and valuations are being re-rated as companies such as Micron shift from book value frameworks to earnings multiples on the back of record margin guidance. SK hynix plans to double capacity over 5 years, raising the risk of future oversupply. But for now, memory prices are climbing sharply, with some reports of 68% sequential increases, while server prices are up 10 to 20% against enterprise IT budgets growing only 3 to 4%. The broader hardware and infrastructure ecosystem is also participating. Hewlett-Packard Enterprise delivered blockbuster results, beat expectations, and guided for fiscal year revenue growth around 31%, with at least 10% penciled in for 2027, driven by strong demand for CPU-based AI servers and networking. ARM is targeting $15 billion of chip revenue by decade end as power-efficient CPUs gain share in AI data centers. Hong Kong names like Tencent are rallying on AI agent plans for WeChat, and Generac is signing multi-year data center backup deals that could more than double its commercial and industrial business. Taken together, the AI infrastructure build-out is a powerful tailwind for growth, corporate earnings, and select equity segments, but it also adds to inflationary pressure in both technology hardware and energy demand. Commentators expect tech sector inflation to filter into headline data later this year, potentially pushing inflation above 4% and nudging long-dated yields toward 5%. A mix that could support earnings in AI-exposed hardware and infrastructure while putting renewed pressure on valuations across more rate-sensitive parts of the market. While hardware grabs headlines, recent software earnings tell a complementary story. Strong results from Datadog, Snowflake, and MongoDB challenge the idea of a broad software slowdown, suggesting AI-driven applications are moving from experimentation into real deployment. MongoDB has raised full-year guidance, added about 2,500 customers in the first quarter, expects several thousand more over the next year, and has reshaped its leadership with a new AI-focused chief product officer. In cybersecurity, Palo Alto Networks is demonstrating that it can grow organically and deliver on management promises, helping to justify recent valuation gains. CrowdStrike is well-positioned to benefit from rising demand for AI-era verification and protection, and its strong aftermarket performance reflects that optimism. Yet the sector's elevated multiples mean that even a small earnings miss could trigger outsized share price reactions. Consumer-facing names are offering another piece of the puzzle. Dollar General beat earnings, raised its outlook, and plans to open 450 new U.S. stores this fiscal year, signaling resilient demand for value retail. Victoria's Secret saw its shares jump around 40% after better-than-expected results reinforced confidence in the turnaround strategy. Ulta Beauty delivered operating margins more than a full percentage point above expectations, nudged its income guidance higher, and is benefiting from the launch of rare beauty across its network and from a powerful loyalty ecosystem. Globally, the MSCI Emerging Markets Index is advancing mainly because of AI-linked leaders like SK hynix, Samsung, TSMC, and MediaTek, while many other markets struggle. At the same time, oil remains a key swing factor. December Brent is trading more than 35% above last year's average and is expected to stay above $80 even if Middle East conflicts ease, as disruptions around the Strait of Hormuz and low U.S. diesel inventories maintain a risk premium and leave energy-intensive and import-reliant sectors facing mounting margin pressure. AI-centric businesses are relatively insulated from direct energy costs, but most of the listed universe is not. Rising oil and refined product prices, alongside double-digit increases in server and memory costs, raise the risk that corporate margins outside the AI complex begin to compress, and that analysts eventually trim forward earnings estimates if these cost pressures persist through the second half of the year. All of this is occurring against a backdrop of very loose financial conditions. Companies are able to raise massive sums in public markets with only modest valuation impact, reinforcing a risk-on tone. Strong U.S. growth and a cautious Federal Reserve, contrasted with a more aggressive European Central Bank, support a constructive view on the U.S. dollar and help keep global capital anchored in U.S. assets. Recent surprise equity raises by Alphabet and SpaceX mean that more than $100 billion could be raised in roughly 10 days, signaling exceptional primary market appetite. Looking ahead, planned mega IPOs from SpaceX, Anthropic, and potentially OpenAI point to a window of strong demand for AI and space-related equity exposure, with Anthropic's confidential filing and rapid revenue growth, making its valuation a key barometer of public market enthusiasm for AI-native franchises. SpaceX is using its bargaining power to push IPO fees toward levels below 0.75%, well under typical mega-deal ranges, even as the sheer size of the raise leaves considerable absolute fee pools for the 23 banks involved. That combination of issuer leverage and still attractive total revenues could reset expectations for future large offerings and provide a meaningful, if episodic, earnings boost for leading global banks. In parallel, private credit remains a major receptacle for risk capital, with senior secured, moderately leveraged structures offering double-digit yields when executed prudently and drawing substantial inflows. Yet competition for assets is increasing, and the 17% redemption request at a Clearwater fund, which sent negative ripples through names like Blue Owl, highlights that stress points are emerging just as large multi-strategy hedge funds such as Millennium and Citadel absorb record inflows and contribute to crowding across popular trades. Putting it together, equities are hovering near all-time highs, powered by a rare combination of a 29% earnings surge and an extraordinary AI Capex cycle, even as inflation, structurally higher yields, and elevated energy prices test how far valuations can stretch. Opportunities are clearly opening up across AI hardware, infrastructure, software, select consumer names, and parts of emerging markets, but they sit alongside growing risks from concentration, crowded positioning, private credit fractures, and the possibility that long-dated yields or oil move sharply higher. From here, the critical signals are labor and inflation data, the path of long-term yields around the 5% threshold, energy supply developments, corporate margin commentary on tech and energy costs, market breadth beyond the AI complex, and how smoothly markets absorb Alphabet's issuance and upcoming IPOs from SpaceX and Anthropic. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.